Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be hosting this particular podcast in the home office. It's not exactly done yet. We got some bells and whistles that we're going to be adding here, making things a little bit more fresh for 2024. But Happy New Year, Ez. How you doing? Good. Glad to hear it. As you know, that the old podcast set in Florence is being moved into my house because the new office in Cincinnati, Ohio, on Linwood Avenue, right in Mountain Lookout, doesn't quite have the same square footage. So this just makes a lot more sense to do it here. It's a little bit more convenient. So I'm excited about doing this for the convenience of a home office. And like I said, the setup's not done, but it's been a couple of weeks since we've done a podcast, and a lot has happened. So I thought it would be really good for all of our audience to hear from us at the start of this new year, given the rough start that we've actually had in the major averages anyway. But we'll get into some of those topics. I'm going to give you guys, listening to the show today, kind of a summary overview of expectations for 2024 that I have, that we've shared with our clients via the newsletter that we send out every single month. You can find all of those newsletters on our website, shepherdwm.com, as well as links to the YouTube page to check out all the videos that we've done. Spotify, if you're walking your dog, working out, when I listen to the podcast that way, it's there. And then, of course, we have all the Friday blogs posted up there as well. So this is going to be a fun show, kind of going over a little bit of 2023, and then looking forward to some really good returns, I think, in 2024 as well. But just checking in real quick for the audience, since we've grown quite a bit, not just on the firm side. I'll talk about that here in just a second, but the audience for this particular podcast has grown quite a bit. We certainly appreciate that. If you guys have questions, you can always send those to me directly, 513-630-2664. Again, you can email it if you go to the website. All that information is there. And don't forget to like the show, share it. Make sure you hit the little notification bell. That way, every time we drop these things, you're aware of that. So certainly appreciate all the support. But this is, what season are we on, Ed? This is 4, right?
Season 4, baby.
Season 4.
Season 4.
Ongoing, but looking forward to an even better year for this show. But 2023 is in the books, as they say. And I know that we had a good holiday season because I got to spend some of it with you. But I'm very, very, very excited here for 2024. Anything, Ez, that you want to get off your shoulders as we move into a new year here? Like something that you're either excited about personally, professionally? Doesn't have to be financial.
I'm excited, real excited to see where season 4 takes us. And don't know how we're going to quit taking it on the keister like we have been this week, you know. But no, I nothing major announcements yet. So
well, I mean, we do here in my household, as you know. You're going to be another uncle. My wife is pregnant. My wife Nicole, she's due to have our second child. Probably sometime in the summer. We're thinking maybe around August. Not for sure yet. She's going to go get checked up on Tuesday. So there's a little bit of news to drop on everybody. But 2024 is going to be exciting for a lot of different reasons. And I had a great holiday season, great New Year. So certainly hope you all did as well. Now, 2023, if we just take a very quick step back. And by the way, before I share all this data with you guys, I'm very excited to share it here with you today because I thought it was a really good newsletter personally. I know it's very biased. I wrote it myself. But I thought it was pretty good. So I'm going to share some of those highlights, and I think you guys will get a lot out of it. But the main reason why we do this show, right, just for the first-time viewers, listeners out there, we like doing this, and this idea came about really because I had a lot of questions from clients that were watching the news. CNBC is in my office, both here in the house and the actual new office in Cincinnati, all day long. And I read a ton of stuff from Barron's, Market Watch. I mean, you name it, I'm consuming that data. And it's my job to do that. And I know that some people have more time to do that than others, but in general, everybody has one of these little smartphones, and we have access to all of that kind of news-related information all of the time. And the news does a good job of actually bringing to your attention, some important information, whatever it may be, geopolitical, economical, whatever, corporate earnings, etc. And all that's great. But what the news does a really terrible job of, in my opinion, is actually giving the listener, the audience, some historical context to that data, saying, yeah, this is important for you to know because of X, Y, and Z. But oh, by the way, nobody should just go and sell all their shares or get too bullish and leverage everything in their account, because there's 17 other times that we went through whatever it is that the headline news is presenting at that point in time. And oh, by the way, here's what happened to these sectors in the market, the overall market over the next 6, 9, 12 months. And the market is forward looking. It's always going to look out and try to price things today, saying, hey, what is this worth today, assuming that these types of things will happen with interest rate cuts or what have you. And if you look at historical records like we do, that starts to give you some pretty good ideas. At least some probabilities are now either in your favor or not. And based on that type of information, you can go about either rebalancing the allocation, keeping the allocation exactly the same. And what I mean by asset allocation is just a fancy way of saying this is how much of your money is invested in stocks versus bonds and cash. And the good news about that is that explains 94% of the variability, the ups and downs of returns for any investor over any period of time. And that should be good news to the individual investor because we can control that. One of the things that we can control is the asset allocation. And the other thing that we can control is our temperament, or emotions, in other words, how we make decisions under stressful circumstances. And that's why I like studying history relative to whatever the headline news is because the market, as you know, is made up of human beings. And human beings, we haven't changed. We haven't changed very much in the last 2,000 years. The one thing that Buffett famously said is, one thing we know for sure about human beings is they do not learn from history. And that's why we spend so much time talking about that. One, the news doesn't do it. And two, this is how the market's trying to price things in today is based on what they expect to happen over the next 6, 9, and 12 months. And that always will change. If market's wrong sometimes, etc. So that's why we do it, is we want to give you guys that information because that's how I can control my temperament. To me, there's only two things we can control. One's the asset allocation. The other one's your temperament. So how do we start by developing an allocation? Well, for me, I have to start with controlling my emotions. The best way that I've found to do that is to study the history of the market under whatever circumstances that we're going under. And right now, the market's trying to figure out when the Federal Reserve is going to start cutting rates after increasing rates substantially over the last 18 months. So that's really what's going on right now from a market perspective. And we're starting to get some economic data points that kind of help us figure out when the Fed might cut, how much they might cut, et cetera. But that's exactly what's playing out today. And I think if we understand history, it starts to give some insights into what might happen. Not a guarantee. Obviously, past performance is no guarantee of future results. Investing involves risk, including risk of loss for all those compliant folks out there that are watching and listening to the program. So that's why we do the show. We certainly hope you guys get a lot out of it. I know that our clients did. We absolutely racked it from a performance standpoint. The average client at Shepherd Wealth Management up 35.5% in 2023.
Wow.
S&P 5, yeah, that's some good stuff right there. But S&P, to put it in that perspective, S&P was up 24% in 2023. So we're very happy about that. But the main reason that drove that performance is we had to make some decisions. We had to say, do we want to overweight technology as an example? We did, big time. How we got to that asset allocation, for those that have been following the program since the beginning, is we put out a newsletter, just like I'm going to go over here today. We did this in January of 23, and everybody was calling for a recession, all the worst things that you can think about from a market perspective. We saw it as an area of opportunity, specifically in the technology sector. We overweighted that big time. What I mean by overweight, the S&P 500 being the benchmark for us. S&P has 11 sectors. One of them is technology. Technology is 30% of the S&P. To put that into perspective, healthcare is the second biggest sector of the S&P, and healthcare is at 15%. So basically, technology is massive relative to all the other sectors.
I didn't realize it was that much bigger. That's huge.
Yeah, it's massive. So we were on average, I'd say 50% on the low end to as much as 80% on the high end allocated towards technology stocks last year. And we also overweighted industrials, which is a decent play, specifically the back half of the year. And we also had a nice exposure to energy, but that was kind of it. We had very little financial exposure. We had very little to no small cap exposure. We didn't have any money in healthcare, which we had a ton of money in healthcare in 2022. And this is how we build the allocation, is based on what history has to say. That helps me control my emotions, because now I know where the probabilities lie. It's not a guarantee, as I mentioned before, but if you can put the probabilities in your favor and saying, hey, if this happened 17 other times in the history under similar circumstances, and the result was a double-digit return, like 84% of the time, now I can start to make some decisions with my asset allocation. Now my emotions are under control, because I'm not guessing. I'm not just looking at whatever the news has to say and saying, Scott Wapner on CNBC seems like a nice guy, and he seems to like this particular sector, so maybe I'll put some money there. Literally, I know people, that's how they make their investment decisions. They find somebody that they like on TV. They seem like a nice male or female. And for whatever reason, like Jim Cramer is a perfect example. I love Jim Cramer. He's a little out there for me sometimes. And
he's got a shtick, you can't fault him for that. You can't.
He's excited. Like, he loves his job. You can tell it, it just exudes out of everything. He
could just be another boring talking head up there. He found a way to like separate himself. So I don't blame somebody for marketing,
No, not at all. And he's got some good thoughts and ideas, etc. But literally, I was working at Fidelity, I was working at TD Ameritrade, all these places. And you're talking to these clients maybe for the first time, just trying to get an understanding of who they are, what they're about, that we can build some relationship with them and figure out if you can help. And I asked, I don't know how many hundreds, maybe thousands of people, like, you have this asset allocation. I'm looking at it, appreciate your business here, but you might just kind of walk me through like how you came up with the allocation that you have with these positions. And more often than not, it was a Susie Orman or a Jim Cramer or something like that is how they got to that asset allocation. So please, if you're that person, please subscribe to this show. I think you'll get a lot out of it. I know our clients do here at Shepherd Wealth Management. Now,
if you have, sorry to interrupt, but if you have any questions, y'all, the number is literally, if you're watching this live or in rerun, the number is right next to my head. Text Joshua.
Yeah, we're here to help. We will help. We'll be glad to help, even if you're not a client. Obviously, we'd love to work with anybody that needs that sort of assistance. But I want to take a step back in time before I get into 2024 stuff here. And this was something that we talked about in our newsletter last January, literally a year ago. So the market pundits, if you will, of all the large financial institutions, banks, brokerage firms, etc. You guys would know them all. If you go to our website and check out the newsletter from January of 2023, you'll see this. But you can also check out the January 2024 newsletter. I put the same slide in there. So like JP Morgan, Credit Suisse, Bank of America, Goldman Sachs, Citigroup, Morgan Stanley, UBS, Barclays, on and on. There's a list here of, I think, 20. All of these entities that are very well known, very well respected. A lot of you probably have, financial relationships with these institutions. And all of them, except for 3, we're expecting the S&P 500 to be flat to negative. The average year-end price target for the S&P 500 for all of these massive institutions was 4,000. Obviously, we finished the year closer to 4,800, right? So they're off by quite a bit. The lowest expectation was the S&P ending 2023 at 3,400. I mean, that group of analysts were way the hell off.
Yeah, way off.
And on the high end, like the highest S&P 500 year-end target was 4,500. So they were off, but not nearly as bad as everybody else here. Now, at Shepherd Wealth Management, we didn't necessarily put out a price target at the beginning of the year. It is something that we're going to do a little bit more of here this year. I'll talk about my price target for the S&P in just a little bit. But we did actually call for double-digit return expectations. We laid out all the historical evidence as to why we felt that that might be the case. And very thankfully, we're very, very accurate about all of that. So again, that's how we were able to control emotion, because of all the people that follow these institutions and took their word as, this is likely going to happen because JP Morgan said so, right? Obviously, Jamie Dimon and their team are a bunch of great bankers and financial, experts, if you will, but they were wrong. And I know a lot of people out there would look at something like what Jamie Dimon or his investment analyst team would have to say. And if they were calling for a recession and a lot of bad news, I'm sure a lot of people set in cash or bonds. And that was nice for a minute when bonds were at 5% and still are at 5% for the most part. You don't even have to go out that far in duration. You can literally buy a 3-month treasury and get over 5% for the majority of 2023. And that might feel good when the last 15 years you couldn't hardly get any interest or any return on fixed income due to the fact that interest rates were basically zero for a very long extended period of time. So initially that might have felt like a smart move, but when the S&P goes up 24% and you're clipping 5% coupons, that's a big opportunity cost for a lot of individuals. And there still is about as much cash sitting on the sidelines as there was in 2008 as we speak here right now. And I think that's one of the catalysts for positive returns in 2024. People, getting out of the treasury notes, money markets, cash positions, and moving that back into risk assets like stocks. But that was a huge opportunity cost last year, and it had nothing to do other than human beings in the marketplace could not control their emotions. So I did a little bit of research. I'm not a psychologist or a therapist, although I would say that about 40 to 50% of my job kind of feels like I'm a therapist, almost every day.
Yeah, you've talked me off the ledge a couple times.
But psychology tells us that there's 27 different emotions that a human being can have at any one given point in time. I don't know the exact statistics on how many thoughts go through an individual's mind every minute, every hour, every day, but it's a lot. And with these smartphones, as I mentioned, everybody's getting all this information all the time. No wonder it's very difficult for investors to control their emotions. Now, emotions are great things. It makes us human beings. It makes us unique. But it definitely is a problem for the individual investor that cannot control those emotions, which again is why we spend so much time, looking at stuff like this. And it's not just my opinion. Literally, you can get a PhD in this topic called behavioral finance at every major university these days. It's just a fascinating study of how human beings make decisions with their money under stressful circumstances. We seem to think that we're extremely logical, but what this study finds in a nutshell is that human beings feel losses twice as much as they feel good about making money. So we're risk averse by nature. When bad things we think bad things are expected to happen, like we don't want to feel like a loser, right? Like the last thing that anybody would want is sitting around the water cooler when the market's up, double digits, and we might be down just because we were allocating the majority of our capital in the wrong sectors. We don't want to feel like a loser, so we just do the safe thing, which is just, I'm going to go buy some bonds, clip my 5% coupons, and I might not beat the market, but at least I don't feel like as big of a loser. So we try to avoid that feeling, and I get that. Nobody wants to make a bad decision. If you've made enough bad decisions, you do everything you can, possibly can, to avoid them. And the problem is, again, when human beings are very busy, they got all these thoughts going on, they got feelings going on all the time, and maybe they're an engineer or a nurse or a doctor, an accountant. They're an artist, they're a teacher, whatever. They don't have all day like I do, because this is my profession, to sit here and consume all this data and then go check out what history has to say about it, and then formulate an asset allocation decision based on all of that. But that's my job. This is my world. This is the one gift that I've been given for certain that I've been blessed with. And this is what I was put on this planet to do from a professional standpoint. I thank everybody else that has all those other different types of jobs, because I suck at all that other stuff.
Well, as no you mentioned, we all suck at financial advice.
Yeah, so that's why I'm here, and I'm happy to do it. This is fun for me. I hope it shows up in everything that we do, whether it's newsletter or podcast, or just sitting down with an individual and understanding them and where they're coming from. But getting back to the newsletter here, if we can't control those emotions and thoughts, we got all this other stuff to do, kids, work, travel, etc. That I can see how we have about as much cash sitting on the sidelines today, even after we had a market go up 24%. I can see how that can happen. Right? If we're only seeing the bad stuff in the news, not getting some historical context around that, I can see why a lot of people really missed out on an excellent year in the market last year. And I think we're poised for another good setup here in 2024, which I'm about to shift gear towards that right now. The one thing that we're thankful about at Shepherd Wealth Management is we didn't pay attention to that noise. I mean, we knew it was there, right? But then we look back and say, hey, what does history have to say about all this stuff? And that worked out to our favor to beat the market on average by 10%. Obviously, not everybody got that return. Some people are in a completely different phase of life from a risk standpoint, but that was the average return, meaning that some people did a lot better than 35% as well. Now, as far as 2024 outlook is concerned, I'm calling a price target here on the S&P 500 at 53.40. And that's roughly a 12% upside from where we began January 2nd being the first trading day. So we're only 4 trading days into the new year here in 2024. Haven't been good. I'll get to that here in just a second. But my price target on the S&P, 53.40, it implies about a 12% upside. And how do I come up with that? Well, it's based on history, if you haven't caught on to that just yet. So when we have a Democratic incumbent rerunning for office, this is going back over all presidential cycles, the S&P 500 average return is actually 12%. So that's why I'm banking on about a 12% average, which means it could be lower than that, could be higher than that. But the good news is the median return is 13.2, being a little higher. The minimum return looks like it was -4, so that's not that bad from a volatility standpoint. And then the maximum return is 27.9, and the win ratio is 75% of the time, which is great. That's about average for any year that we wake up on January 1st. Literally on January 1st of every year, there's about a 70% or so chance that you'll actually, just by participating in the market, have more money than what you began the year with. So that's how we came up with a price target of 53.40, as because it's based on historical precedents. Which a lot of people might not even know that. Like a lot of people come into election year, they're like, shit, man, I'm going to have to deal with all these commercials and people knocking on my door and, all this stuff. And it typically is a lot of very bad news that's out there during an election year. And I understand that. I don't necessarily want to be bombarded by 50,000, advertisements every time you turn on the television or listen to the radio for that matter. But it's coming. We all know it's coming. But I want to get into the history of the markets, and I'm about to do that right now. So we talk about the market, being around all-time highs right now. So first of all, let's put into perspective last year real quick, just to wrap this up in a nice little bow. So with the S&P up 24% last year, 2023, that only ranks as the 25th best year in the past 125 years of market data. That might be surprising. Yeah. So basically, the markets go up a lot or they go down a lot in any one given year. It's very rare that you'll see around a flat market. Maybe I know a lot of people are calling for -5 to 10% on the S&P, or maybe a positive 5 to 10%. Those folks just don't know anything about market history. That only happens about 11% of the time. You get that kind of result. Usually, markets are moving a lot to the upside or a lot to the downside on average in most years. And when we closed the year, the S&P was within 1% of its all-time high close of 48.01. Obviously, we have not exceeded that just yet. But since 1950, there have been 11 instances when the S&P 500 fell 20%, like in 2022, and then climbed to within 1% of its prior all-time highs, just like in 2023. So that's happened 11 times since 1950. The median length of time it took to exceed its prior all-time high was 7 days. It took as long as 20 trading days. As I mentioned, we've just completed the 4th trading day of the calendar year here in 2024. So if history is any indication of repeating itself, it's potentially very probable that we exceed that 4801 all-time high on the S&P sometime here in the month of January if history should repeat itself. And that kind of makes some sense to me because we do have some catalysts, one of which we got today, which was the jobs data. And I think finally, for the first time in 2024, this was not true in 2023. Like we were kind of hoping for Goldilocks news in 2023. Like market would expect inflation to be like 0.2% month over month, and jobs were expected to be around 200,000. Let's say that was the key data point on that particular Thursday in 2023. Well, we were kind of hoping that we'd have a little lighter on the jobs, but not too light, and then have inflation come in line, maybe slightly below consensus expectations. We saw that a bunch last year. So this year, I think we actually want to see the good news. We want to see robust jobs, but we also want to continue to see inflation continue its trajectory to the downside like it has over the last 12 months or so. And we got that today. So the market was expecting about 170,000 new jobs that were created or for individuals back in December. And we actually got 216,000, which to me is fantastic because 70% of this economy that we live in the United States is the consumer. And as long as the consumer has a job that's paying them, they will consume stuff. So that's obviously a good thing for corporate profits, which we're about to get into beginning next Friday with all the big banks. We'll start to report, and that's kind of kicking off earnings season.
Here it comes. Yeah. The brief amount of info before we just throw the election down the podcast listeners' throats.
Oh yeah, I'm already excited. But the good news is we're not talking about Jay Powell every day, right?
That is good. Yeah,
I'm so done with that guy.
just wait till they get the first rate drop and he takes this massive victory lap that's like 6 years long.
I wish he was a podcast listener. He's probably not. But yeah, I'd love to have at least a phone call with the guy.
We can get him on, maybe. I'll
see
what I can do. I don't know.
Have your people call his people. See what happens.
By my people, I mean me, real late at night.
But I mean, that kind of begs the question. Like the natural question should be, did markets, are they going to exceed all-time highs and extend them or not? Now, the median max gain over potentially the next 18 months, might be, again, as I mentioned there, as high as around the 20%, 22% or so. So there is potential for that. And once we do exceed an all-time high, the market doesn't typically just reverse back because that's a very big deal when we get a new all-time high. So if we do exceed that, I would expect that to extend itself for a period of time before kind of consolidating back, which means you might see the market, hit that all-time high sometime here in January if history were to repeat itself. Maybe sometime mid to late February or early March, you're potentially seeing the market consolidate a little bit. And I think the market is getting very itchy or antsy, if you will, for interest rate cuts. And I understand that, but I think that should be the case. I would definitely welcome an interest rate cut as soon as March. The probability for that, believe it or not, is actually like 73%, even though the Fed is very adamant in saying that they're kind of hell-bent on keeping rates where they're at until it's damn near 2%, like until they can't hold it there anymore because of public scrutiny would just eat them alive, and their quote-unquote credibility would be. What was that?
The like last time I think we did an episode, the probability of a March rate hike was pretty much 50-50, so it's gone up even, huh?
Yeah. So before we got the jobs data today, it was actually like 63% probability. Then post jobs announcement, again 216 versus the market thinking 170, the probability dropped back down to like 53%. Because if it kind of makes some logical sense. Like if the economy's, job is unemployment rate still under 4%, 3.7, not changed, that would allow the Fed potentially to hang on to where rates are at just a little bit longer, right? Because everybody has a job, which typically means the economy is going to do okay. As I mentioned, that's 70% of our economy here. But then shortly after that, maybe about an hour later, the probability jumped back up to 73% and ended the day there. So it's very dramatic, in my opinion. I would welcome an interest rate cut in March. I think that would be the right and prudent thing to do, because if you're looking at something like the PPI index, which we will get on Friday, CPI will be next Thursday, PPI will be next Friday. So PPI is a producer price index. That's basically wholesale cost. Now that inflation print has been way below the CPI print for, I don't know, maybe 2 to 3 quarters now. It's been substantial. And that gap is eventually going to show up in CPI data, that headline inflation number. And the Fed knows all this. So I think it would be prudent to have a small interest rate cut, 25 basis points in March. Although I'd say I disagree with the probability of 73% of that happening. The only way it's 100% slam dunk, they're going to have to cut rates as soon as March, is if the CPI print and the PPI print that we get next week on Thursday and Friday morning, if that's way below expectations or maybe even negative, which is possible, then, outside of that, I don't think that they're actually going to cut rates in March, which means you could see some volatility, as I mentioned, even if we were to see all-time highs in the month of January. Now, reasons why we might expect markets to continue to grow in 2024. It's all about inflation and what the Fed's going to do with the Fed funds rate. How much are they going to cut? How fast are they going to cut? I do believe once they do cut, they'll cut rapidly, maybe even bigger chunks, and maybe more than what they think. So the Fed's kind of telling everybody that they'll do 2 or 3 cuts this year. The market's looking for at least 4 and as many as 6 interest rate cuts in 2024. I don't think we're going to get 6. That would be like a recessionary type of event, which I don't know how that could happen. We got the unemployment rate at 3.7%. So I'm definitely not calling for a recession this year. The more likely outcome is we start to get to 4, maybe 5 interest rate cuts, which would be awesome. Now, I've been sharing with everyone my personal feeling, just because I think Jerome Powell and his Fed head friends are kind of hell-bent on keeping rates high, just to act like they're super tough and fighting the inflation war, if you will. But they know damn well as good as I do that they've got that thing under control. And many leading inflation data points would say that they're already basically right there at that 2% number that you're looking for on headline inflation. It's just when is that actually going to show up in the data? Because the biggest chunk of the CPI data is housing. That has the longest lag effect, and that's set to fall pretty substantially here. And I think that might actually start to show up in the inflation print next week. So that's really the main catalyst as to why we think the market's going to have another double-digit type of year outside of the historical data. But we actually think that most of the gains, so if we're looking for a 12% rise in the S&P by the end of 2024, I think the vast majority of that gain is probably going to come right around May, June, when they start to significantly cut rates and the market's starting to price in more and more rate cuts, which makes perfect sense to me. So just kind of expect, while the market is very antsy for interest rate cuts, to expect some volatility here, even if we exceed the prior all-time high on the S&P sometime here in Q1. Now, the other reason why we feel good is we actually think that earnings are going to hold up great. Earnings growth expectations are expected to be around 11%. We have a slowing economy, meaning the GDP number is not as robust as it was last year, as an example, but it's still a positive GDP number, which also would negate any recession fears. But with positive GDP and earnings holding up with interest rates coming down, that's a pretty good recipe for positive performance in the stock market. Now, the other reason why we feel good, artificial intelligence. I know it was a huge buzzword last year, big reason why tech stocks did as well as they did. Those products are now being implemented into their services. You'll see more and more productivity gains from that. And that spend, that corporate dollar spend on things like cybersecurity and artificial intelligence type of technology isn't going anywhere anytime soon, regardless of where interest rates are at, or who becomes president, or any of those other things. Global growth is also a bullish reason. We expect double-digit results again in 2024. last year, Europe was dealing with a mess of inflation. You also had China coming out of a zero COVID policy. And both of those major sectors of the global economy really didn't do anything at all from a positive growth standpoint in their markets. But if they get that under control, turn it around, I think the demand could be quite strong overseas as well. And I just don't see the consumer slowing down, as I mentioned, kind of at the top of the program here. So that's our reasoning behind why we expect that. And we also talked about the historical data regarding presidential election cycles. And then lastly, we also mentioned this at the beginning, is the investors that have been sitting in cash for far too long and missing out on this growth that we've seen in the S&P 500. I think the FOMO really kicks in for those individuals, and they start to participate in the market in a much bigger way. So with all that being said, I gave you guys some historical data, price targets, the reasons why you should feel pretty good, even though the first part of the year here is terrible. I want to talk about that here right now, actually, before I get into the sectors that we like and how we're positioning clients. So as I mentioned, first 4 trading days in the stock market this year, we've seen the S&P 500 down about 2% over those 4 days. And the Russell 2000, which is the small cap index, that's down 3.5%. I think the NASDAQ's down closer to 5%. So it's been a rough start for the year, no question about that. And I really do believe it's just investors are trying to figure out when the first rate cut's going to happen, because after that first rate cut, I think the rate cuts come rapidly and consistently throughout the remainder of the Federal Reserve meetings there. And that actual volatility that we've seen here to start the year has caused that quote-unquote Santa Claus rally to fail. The Santa Claus rally is kind of defined as the 5 last trading days, December, plus the first 2 days of January. And over that period of time, stocks are actually down 1.6%, as I mentioned, throughout the first 4 trading days of this new calendar year. So with all that being said, what sectors do we like? So our top picks sector-wise, and it's actually not a sector in the S&P 500, just to be clear, but it is a part of the investment options that an individual has. The small caps. So small companies, so small caps is typically a company that has about a market cap of between 1 billion and 5 billion. I know that sounds like a lot to the individual, but that's a rounding error for a $1 trillion company like an Apple or Microsoft or something like that. So why small caps? Why is that our favorite sector pick for 2024? It's a theme of what does the best historically when we're in a interest rate cutting cycle, which we're going into here in 2024. And small caps would be expected to do the best under those circumstances. They got crushed when interest rates were going up. I mean, they absolutely got crushed, just as they got crushed worse than technology did as the Fed was increasing interest rates. And small caps, by the way, has actually underperformed the S&P for about 12 years in a row now, which has been a historically long period of time for that space in the market. But small caps, why is it our top sector pick? It's because as interest rates start to come down, those smaller companies, they finance their operations. They don't have $200 billion sitting in cash like Apple does. So they have to finance their operations, and as the cost of capital goes up, that squeezes their margins, etc. As that cost of capital comes down, expands margins, and that area of the marketplace has been beat up so bad. Even if it did have like a 50% return, I think it could happen, just like tech stocks last year had a 50% return. It's possible that small caps could have a 50% type of return. It's not a guarantee. The reason why I feel that way is if that were to happen, that would really just catch small caps up to everything else that has grown in the S&P 500. So it's possible, but I do think that would probably be the best performing area of the marketplace. And that's where we're going to have the biggest overweight positioning wise on the asset allocation for our customers. We also really like industrials. And this is kind of a no-brainer to me. You do not want to buy industrial companies, manufacturing companies, when they're doing great. You want to buy them when everybody doesn't want to own them at all. And a lot of people, based on the data that we've got from the ISM manufacturing data, came out today at 50.6. which is kind of weak number. Like you'd like to see something in the mid 50s pushing up towards 60. A lot of people are kind of boo-hooing the industrial space, but that's the time that you want to enter the sector itself. And on top of interest rates coming down, obviously that makes the cost of capital and funding their operations better from a margin perspective. You also have the government itself getting ready to spend trillions of dollars on roads, chip factories, airports, everything along those lines that requires manufacturing companies to get that job done. So that's a big reason why we want to be overweight industrials. For the listener that's listening to the program or watching it, industrials, of course, is one of the 11 sectors in the S&P. It's about an 8.5% weighting in the S&P 500. So for our customers, we want to have more exposure to industrials than the S&P does. Again, we're making these decisions and anticipating that the data will come out our way. And if it does, just like last year, because we overweighted these sectors that did better than others, that gives us the highest probability of actually outperforming the S&P 500 for our customers that are looking for that type of return. Another space that we really like that benefits from an interest rate cut cycle is the home builders. Basically had no exposure to that last year. I think we dabbled in it for a couple months, kind of as a shorter term trade once we thought we were at peak rates, and it did work out for us, but we're going to go right back to that. Instead of owning individual home builder stocks, I think the whole basket's going to do well. So there's a ticker for that. It's an ETF. The ticker is ITB. And you're going to see if you look at the underlying holdings of that particular ETF, it means the biggest players in the home building space. So again, why home building stocks? Why that sector? It's because as interest rates come down, the demand for buying and selling homes picks up. And we're already in a deficit from a housing standpoint in this country. We need about 5 million more homes than what we currently have. And that's going to take quite a while, which again also kind of helps industrial companies at the same time. So those are our major sector picks. We still like technology, by the way. We're going to own it. We're going to own the individual names that we owned last year, but we're going to do it in a lesser weighting. So last year, as I mentioned, we were at least maybe 50% in everybody's account in tech exposure for the part of their asset allocation they wanted to have in stocks, and some as much as like 80%. Younger folks, higher risk tolerance, longer time frame until their retirement age comes about. So we still like tech, but instead of owning that big of a percentage, we're going to bring that right back down to a market rate. So we're going to be neutral in the S&P 500 probably to start the year anyway. And all of this is, of course, subject to change. So you're just going to have to keep listening to the podcast or checking out the newsletters on our website. So we still like tech, but we're going to bring that back down to market rate. And then lastly, energy, we'll have a little bit of exposure there. I think that can do well if Europe and China kind of re-engages from a demand standpoint. I would expect that sector of the market to do well, although it is the smallest sector of the market. Energy is only 5% of the S&P 500. So even if you're market weight to underweight that area, it's not a huge mover for the S&P 500 anyway, but it's probably a place we're going to have some exposure to, specifically from the February timeframe to about September. Historically, that's it's a good time to be in the energy space. Definitely would be good if Europe and China kind of re-engage and re-emerge from a growth standpoint for their respective economies. So those are the major plays that we're going to have here, as it's the asset allocation that we're building. I gave you guys a lot of historical data about the markets, and I'm just scrolling through here to see if there's anything else. Oh yeah, I think we touched on this in a prior podcast as last year. I know I gave you guys all that data right up front. I should have tied this piece with it, but retail investors, the do-it-yourselfers, the folks that, again, are working their jobs, they're living their lives, they have families with kids, and they're seeing all these major financial institutions talking about how bad 2023 was going to be. Literally $240 billion came out of the stock market last year for the do-it-yourself retail investor. Again, I can't stress enough that that emotional issue that you guys are struggling with is the cause of this. That headline risk has cost you a ton of money. I just wanted to kind of point that out, I guess, one last time before we move along here. And as far as the rest of the year goes, again, we'll keep doing this about every 2 weeks from a podcast. scheduling standpoint. If something changes, we'll let you all know. But you can expect that to come from us. Ez, any last minute thoughts before we wrap up this podcast at the beginning of 2024?
I got nothing. Looking for a big yeehaw 2024.
Yeah, I am too, my friend. So appreciate you guys watching the show, listening to us. We'll be back again in a couple weeks. Again, you can always check us out, shepherdwm.com, for everything that we do for our customers, as well as all the blogs, Friday blogs, the newsletter, podcast, all that stuff's right there on the website. All the information about myself, my firm, my business partner, John Ashcroft, president of the company, and our new office location also is on there. So I'm very excited for a lot of reasons in 2024. But I hope you guys enjoy the show, and we'll catch you again in a couple weeks. Take care.